For decades, the US dollar has been the king of global finance. It's the currency of trade, the backbone of international reserves, and the standard by which everything else has been measured. But today, we're witnessing a change that could redefine the entire financial system. Countries, institutions, and even individual investors are dumping dollars and rushing toward gold. And the big question is, why? It starts with trust. The dollar's dominance has always been built on the idea that the US economy is stable, its debt is manageable, and its government is reliable. But with record-breaking national debt, persistent inflation, and constant money printing, that trust is fading. Think about it. When the supply of dollars keeps rising while their purchasing power falls, people start to question whether holding on to those dollars makes sense at all. And that's exactly what's happening now. The world is responding in the most predictable way possible by moving into gold. Gold isn't just shiny metal. It's history's oldest form of money. It doesn't rely on governments. It can't be printed at will, and it has held value for thousands of years. When confidence in paper currencies falls, gold rises. We're seeing that play out right now as central banks, particularly in Asia and the Middle East, quietly accumulate massive amounts of gold. Good investment. They're not doing this for fun. They're preparing for a future where the dollar no longer holds the same weight it once did. What makes this even more significant is that it's not just countries making the shift. Investment. Investors across the world are hedging their portfolios with gold, treating it as insurance against a weakening dollar. And this isn't just about wealth protection. It's about survival in a financial system that looks less certain every single day. When people fear a crisis, they don't flock to cash, they flock to gold. That's exactly the trend we're seeing now. But here's the part that directly impacts you and me. If the world is moving away from the dollar, the effects ripple through everything: the cost of imports, the strength of investment, even the stability of retirement savings. A weaker dollar doesn't just mean higher prices. It can mean less influence globally, fewer financial advantages for the US, investment, and a tougher environment for everyday families trying to protect their wealth. The reality is simply the dollar crisis isn't some far-off possibility. It's happening in real time. And everything makes a good investment. And whether you're a small investor, a retiree, or just someone trying to make sense of the world economy, understanding this shift is critical. Gold isn't just a metal anymore. It's a signal. A signal that the financial world is preparing for a new era, one where trust in the dollar may no longer be guaranteed. So the real question isn't whether the world is moving to gold. It already is. Investment. The real question is, how will you prepare? The US dollar has carried the reputation of being the world's reserve currency for decades, but that position is not set in stone. It became dominant after World War II because the United States had the strongest economy, the deepest financial markets, and the credibility to back its promises. For years, this gave the dollar a unique advantage. Nations stored their wealth in it. Commodities like oil were priced in it, and international trade revolved around it. But when a currency rests on the perception of stability and strength, investment, cracks in that perception can shift the balance of the global economy. That's exactly what we're seeing today. The United States has accumulated record levels of debt, trillions upon trillions that grow every single year. When investors and governments look at that number, they don't just see borrowing. They see a future where repayment becomes less likely and reliance on constant money creation becomes the norm. This weakens trust. Add to that the persistent inflation we've been experiencing in recent years. A dollar that used to stretch far now struggles to cover the basics, eroding purchasing power both domestically and internationally. Inflation isn't just a US problem. It's exported globally because so much trade is tied to the dollar. For countries holding massive dollar reserves, the question arises, why store wealth in a currency that loses value over time? When trust starts to erode, alternatives come into focus. Nations like China, Russia, and even allies in the Middle East are exploring ways to conduct trade outside the dollar system. The more trade that happens in other currencies, the less demand there is for dollars. And when demand falls, so does influence. The United States has long benefited from what economists call the exorbitant privilege of issuing the world's primary reserve currency. This privilege allows the US to borrow at cheaper rates, print money without immediate collapse, and exert enormous leverage on global financial systems. But privileges only last as long as others agree to play along. As confidence wavers, investment, the incentive to diversify grows stronger. It's important to remember that reserve status is not permanent. Before the dollar, the British pound sterling was the global currency of choice. Before that, it was other European powers. History shows us that dominant currencies rise and fall depending on the strength of the issuing nation's economy, its fiscal discipline, and its ability to inspire confidence. The dollar is not immune to these forces. The massive US debt load, combined with an endless cycle of deficits and political gridlock, sends a message to the world that perhaps it's time to look elsewhere. Central banks aren't blind to this reality. They're adjusting by reducing their reliance on the dollar and seeking stability in assets that governments can't manipulate at will. What we're witnessing isn't just a financial shift, it's a psychological one. The perception that the dollar is invincible is fading, and in global finance, perception often becomes reality. If enough players lose faith, the system begins to change slowly at first, then all at once. This is why the dollar's role as the reserve currency is under more pressure now than it has been in decades. Investment. It's not collapsing today, but the signs of strain are undeniable. The question is no longer if change is coming, but how quickly it will unfold. Countries and investors are not turning to gold by accident. Good investment. They're doing it because gold represents certainty in a world where paper money feels increasingly fragile. For thousands of years, gold has been humanity's ultimate store of value. Unlike the dollar, investment. It can't be printed, it doesn't rely on political promises, and it can't be devalued overnight through government policies. That's why whenever people lose confidence in currencies, investment, they instinctively go back to gold. Today, that instinct is stronger than ever. Inflation, rising debt, and geopolitical uncertainty are shaking trust in the US dollar. Makes a good investment, and gold has re-emerged as the preferred safe haven. Take a step back and think about what gold represents. If you hold a dollar bill, its worth depends entirely on faith in the US government and its central bank. Investment. But if you hold a bar of gold, its worth exists independently of any government. Gold has the same value whether it sits in a vault in New York, a bank in Beijing, or the hands of a farmer in rural Africa. It's universal, it's tangible, and it has never gone to zero. This reliability makes it the natural hedge against the uncertainties of paper money. As inflation eats away at savings, as deficits balloon, and as confidence in global stability fades, gold's appeal becomes obvious. It doesn't just hold value, it protects it. Central banks understand this better than anyone. That's why they're quietly increasing their gold reserves at record levels. Countries like China, India, and Turkey are leading the charge, buying tons of gold to diversify away from the dollar. These nations recognize that relying too heavily on a single currency, especially one tied to a country with mounting debt and political division, carries significant risk. By shifting to gold, they're insulating themselves from potential dollar instability, and this isn't just a short-term play. It's a long-term strategy to build resilience in an unpredictable financial system. Investors, too, good investment, are reacting in the same way. For the average person watching the dollar lose purchasing power year after year, gold feels like a lifeline. It doesn't generate interest or dividends, but it offers something more valuable: security. During periods of crisis, whether economic recessions, wars, or banking failures, gold historically surges while other assets collapse. Investment. That's why portfolios that include gold tend to weather storms far better than those entirely exposed to currencies or equities. It acts as insurance, a financial shield against the unknown. What's fascinating is how psychological this movement really is. Gold itself doesn't change. An ounce of gold is still an ounce of gold. What changes is how much people trust everything else. When confidence in the dollar or other currencies falls, demand for gold spikes and prices climb. It's a global vote of no confidence in paper money and a signal that people want something real, something immune to the decisions of politicians or central bankers. The shift to gold is more than a financial trend. It's a reflection of fear and caution. It tells us that governments, institutions, and individuals no longer see the dollar as the unshakable foundation it once was. Instead, they're preparing for a world where paper promises might not hold up, and in that world, gold becomes the anchor. The rush to gold is not a fad. It's the clearest sign that confidence in the dollar is eroding, and when confidence fades, people fall back on the one thing they've trusted for centuries: gold. ChatGPT said, investment. Central banks are some of the most powerful players in the financial world, and their actions often speak louder than words. When they start making moves, it's usually a sign of where the global economy is headed. Over the last decade, and especially in recent years, central banks have been quietly stockpiling gold at levels we haven't seen in decades. This is not a random decision, investment, nor is it simply about diversifying their reserves. It's about reducing dependence on the US financial system and protecting themselves from the vulnerabilities of the dollar. Investment. When a government with vast reserves of foreign currency starts trading a portion of those dollars for gold, it's sending a very clear message. Confidence in the dollar is no longer absolute. To understand why this matters, consider how global reserves typically work. Central banks hold large amounts of foreign currency to stabilize their economies, pay for imports, and defend their currencies in times of crisis. For decades, the overwhelming majority of those reserves were held in US dollars. That made sense when the dollar was stable, the US economy was dominant, and trust in American institutions was rock solid. But the current reality looks very different. With US debt levels soaring, inflation eroding purchasing power, and geopolitical tensions creating uncertainty, central banks are rethinking their strategies. Gold, unlike the dollar, doesn't come with political baggage or the risk of sanctions. It's neutral, it's tangible investment, and it doesn't rely on America's fiscal discipline. Countries like China, Russia, and India are leading this movement, but they're not alone. Smaller nations, even in Africa and the Middle East, investment, are quietly increasing their gold holdings as well. For countries that fear being cut off from the dollar-based system, whether through sanctions, financial restrictions, or political disputes, gold represents independence. By holding more gold, they reduce the risk of being vulnerable to decisions made in Washington. This shift also signals a growing desire for a multipolar financial system, one not dominated solely by the US and its currency. The scale of these purchases is important. Good investment. We're talking about hundreds of tons of gold being added to reserves each year, and these aren't temporary moves. Central banks are long-term players. They don't buy assets on a whim or for quick profits. Their decisions are strategic, often designed to shape the next several decades, not the next few months. If they're moving into gold, it's because they see the dollar's future as increasingly uncertain. And when the most informed, most resourceful financial institutions in the world take steps like this, ordinary investors and governments pay attention. This trend also creates a ripple effect. Investment. The more gold central banks buy, the higher its price climbs, which then encourages other institutions and private investors to follow. It becomes a reinforcing cycle. Investment. Declining confidence in the dollar pushes central banks toward gold. Their actions push gold prices higher, and rising prices validate the move to gold as a safer store of value. Over time, investment, this builds momentum that shifts the global financial system away from dollar dominance. The takeaway is simple but powerful. When central banks, the very institutions that once relied on dollars as the foundation of their reserves, start turning to gold, it signals a profound change in the global economy. This isn't about abandoning the dollar overnight, but about creating a safety net, a plan B. That the fact that the people managing the world's largest reserves feel the need for that safety net tells us everything we need to know the dollar's dominance is no longer taken for granted. ChatGPT said, when we talk about the dollar losing influence and gold rising in importance, it might sound like something that only affects governments, central banks, or big institutions. But the reality is that these shifts trickle down to every single person in everyday life. If the dollar weakens because the world is moving away from it, the first and most obvious impact is higher prices. A weaker dollar means imports cost more. And since the United States imports everything from oil to electronics to food products, households feel it almost immediately in their budgets. Groceries, gas, and consumer goods get more expensive, stretching paychecks thinner and reducing the overall standard of living. Inflation becomes harder to fight when the currency itself is losing global trust. Beyond the cost of living, the ripple effects touch investments and savings. If global demand for dollars falls, the value of US assets like treasury bonds could drop as well. That means retirement accounts, pensions, and portfolios heavily tied to US government debt may face losses. People who thought their money was safe in traditional investments could find that safety eroded, not because of poor financial planning, but because of a global realignment that undermines the very foundation of those investments. Meanwhile, gold and other tangible assets could rise in value. Investment, widening the gap between those who prepared for this shift and those who didn't. There's also the issue of economic stability. For decades, the US has been able to borrow cheaply because the dollar was the world's reserve currency. If that demand weakens, borrowing costs rise, leading to higher interest rates across the board. That impacts mortgages, credit cards, investment, business loans, and the overall economy. Imagine a scenario where everything from buying a home to starting a small business costs more, not because of local policies, investment, but because the global financial community has less faith in the dollar. That's the kind of hidden consequence most people don't think about, but would feel directly. On a bigger scale, investment. The dollar's reduced dominance also means reduced geopolitical influence. Part of the US power comes from controlling the currency that everyone else needs. If more countries bypass the dollar in trade or rely on gold, instead, America's leverage shrinks. This could lead to a world that is more divided, where alliances shift, and where financial systems become fragmented. And a more fragmented financial world is often less stable, meaning more volatility in global markets and ultimately in people's everyday lives. The lesson here is clear. Investment. The dollar crisis is not just an abstract debate about international finance. It's about how much you pay at the store, how secure your savings are, and how much control your government has over its economic destiny. Investment. The world rushing to gold is a signal that confidence in the dollar is slipping, and when that confidence erodes, ordinary people feel the consequences most sharply. Investment. Preparing for this shift means understanding that traditional assumptions about money and safety are changing. Those who adapt by diversifying assets, staying informed, and planning ahead will be in a far stronger position than those who simply trust that the system will never change. History shows us that it always does